Welcome, Bruce.
Yeah, thanks, Neil. Thanks for having me. Appreciate you hosting this event, and hopefully everyone who's out there will get a good sense of not only what we do at StoneCastle, but get a good sense of the three different companies that are presenting today, because they're all companies that we know, and so that's obviously a great platform for everyone to get that experience. So just a couple of housekeeping items. If you guys have questions, you can put them in the chat box or the question box. And once I'm done, we'll get to those. So how we want to run today is I'm going to talk a little bit about what we do at StoneCastle, how we manage our portfolios, and then talk a little bit about some opportunities that we see in the markets right now. So for those of you who aren't familiar with StoneCastle, we were founded in 2008. We have over 40 years of combined industry experience. We manage a number of different portfolios. We manage 3 mutual funds, 2 for purpose investments out of Toronto, the Canadian Income Growth Fund and the Canadian Equity Growth Fund. And then we manage the StoneCastle Cannabis Growth Fund for Spartan out of Toronto. And then we also manage our own fund, which is the StoneCastle Fund. It's really our best ideas fund, and it's managed through here. And we really have our clients high net worth individuals and some corporations that are in that portfolio. As far as performance and sort of what we've done in the past and why we think that obviously what we do is great is you can look at the performance here of the 2 purpose portfolios that we manage. We've always had long-term success. If you look at our 10-year numbers and our since inception numbers, you can see here really strong numbers across the board, and ones that we're super proud of. So looking at investing, why is it so hard? Obviously, it takes time, it takes know-how, and this is what we really think we bring to the table. We spend a lot of time looking for individual investment ideas. We spend a lot of time trying to figure out whether or not we're on offense or defense, at any given time. And really that's the, sort of the special sauce that we put together to really build our process and to drive the numbers and the performance that we've seen for clients in the past. So with the StoneCastle process, we talk about it being definable, repeatable, predictable. Definable in that we've got criteria for why we're on offense, why we're on defense. We also have criteria for why companies go into our portfolio and come out of our portfolio. Repeatable in the fact that we could take the data today, we take the same data 10 years ago or 10 years from now, and we'd end up with a very similar portfolio. And predictable in that we'd love to be able to generate predictable returns, but that's not possible. The fact that human emotion is involved in investing, that's not possible. But what is possible is that we can generate predictable attributes and characteristics of our portfolio. And we know those attributes and characteristics are what lead to our long-term performance over time. So the first thing that we always try to figure out is what's the real long-term cycle? Where are we at in those long-term cycles? And you can see here that, obviously the market has these long periods where it trends up and long periods where it trends sideways. At any given time, inside those, there's obviously movement. We're trying to figure out what to do inside of that movement as well. So we have our top-down process. We talk about being on offense, neutral, or defense at any given time. Now, what we're looking at is we look at a number of different economic and market indicators. And effectively, if we have a checklist of a number of those, if there's boxes checked in every single category, then we're on offense. As we start to lose those boxes and they become unchecked, we move into neutral. And then as we see more boxes get unchecked, we move into defense. We don't have to go from offense to neutral to defense. Lots of times we go from offense to neutral, back to offense again, depending on the circumstances and how things dictate. If you want to learn more about this top-down process, we actually host a monthly webinar where we break down all of the criteria for both the economic and the market indicator side of things. Easy to follow along. It's usually about a half an hour. We do it once a month. If you want to sign up, you can send a message to info@stonecastlefunds.ca for that. So what are we looking at? We're looking at economic indicators. So, these are just some of the things that we look at. Effectively, what we're trying to do is always trying to figure out whether or not a recession is imminent and something that's going to be happening sometime soon. Obviously, if it is, typically the markets are going to behave in a negative fashion, and we want we want to be protecting our portfolio in the event that that's going to happen. So we look at, this isn't an exhaustive list. It's just a few of the things that we look at. So, as an example, we'll look at the ISM service index. So, we always want to know, kind of where things are at from a service index standpoint. And, are we expanding? Are we contracting? We do something that's a little bit different at StoneCastle. We actually look at a lot of economic indicators from a technical basis. So we're looking for rate of change. The market really doesn't care about the absolute level of, anything, if that's earnings, if that's, economic numbers. They're looking at the rate of change. And as long as that rate of change is improving or decelerating, then that's really where, things come into play. Another example of something that we look at is we look at, industrial production. And in this case, this is looking at it with the moving averages. And so, we're looking for that acceleration and, crossing over moving averages to really take us into the next phase. We also look at market technical indicators. So again, we're looking to see, kind of where the supply and demand is in the overall market. How broad is it? Is it expanding? Is it decreasing? And what can we expect kind of going forward? So when we break it down a little bit further, we look at, we start with something called our asset leadership model. So what we really want to determine here is we're trying to figure out which asset class is the top performing asset class. And what we know from our experience is that, if domestic and foreign equities are the number 1 and 2 top positions, then we know that, typically you're going to see, very strong returns in the market. As we start to see, a transition and we see that fixed income or cash start to creep up this list, it can be, more difficult to generate positive returns. So if you look at this is just looking at it over, kind of the last year. You can see how things have transitioned. The end of 2019, domestic and foreign equities were number 1 and 2. When, everything hit with COVID a year ago, fixed income and cash went to the number 1 and 2 spot. And then as the year went on, we continued to see equities start to perform and move up to the top of the list. And you can see here, as we exited last year, we had domestic and foreign equities in the number 1 and 2 spots, which is where we sit today. And, obviously we've continued to see, real strong breadth of the market. You continue to see strong leadership across the board. That wasn't the case if we go back to, kind of Q1, Q2. You can see here domestic equities was in the number 2 spot behind fixed income. But if you think back to what the market was rewarding, technology and precious metals was really the only 2 places to be. There were some other areas, some sort of select areas, but generally that was the area. And then as we've seen things move along, we've seen the market broaden out. If we look at kind of where we are today, what we're seeing is we're actually seeing what I just mentioned here. So we have, domestic and foreign equities in the 2 and 3 spot, and we have commodities in the number 1 spot. And interestingly enough, if you look at this chart here over on the right-hand side, this is looking at the Dow Jones global indices versus the 20-year U.S. Treasury. And you can see here, these are monthly bars. So each bar represents 1 month in time. You can see here, these are trends that don't happen and change, frequently. And so what we see is that, when the bars are going up, that's equity really having relative strength to fixed income. And when the bars are going down, the opposite. And what we recently saw was we just saw this equity take over control and break out. And so it's kind of interesting knowing that, these trends tend to last, sort of 12, 18, 24 months, that we're only, just a few months into what we've seen as that breakout. We're also seeing international equities outperforming U.S. equities. So this here is a relative ratio to the S&P 500 to the Dow Jones Global Index. When the line's going up, the S&P 500 is outperforming. When the line's going down, the global index is outperforming. You can see here, this is years along the bottom. So these are long-term trends that last and stay in place for a number of years. Now, if you go back in history and kind of think about, performance and where the Canadian markets and the US markets have performed, because of the heavy exposure to commodities, Canadian markets tend to perform very well with international markets. So you can see here, from that period of time from, 2001 after the tech wreck to really kind of 2008, we saw this relative outperformance of the TSX and global indices. we're now just at that point here where things are crossing over. So, from an opportunity standpoint, a lot of investors have been in the U.S. and been focused on U.S. securities. Obviously, the technology and the FANG stocks have been kind of all the rage. Well, we could be at a real inflection point here where things are going to change and head in a completely different direction. So where's the trend? We're always trying to figure out what the strongest sector is, what the strongest asset class is, and what the strongest market is. So, this is just looking at relative strength information. In this case, this is the Canadian ETF, and this is a relative rotation graph. So what it is showing us is that securities, indices, anything that really is tradable, we'll go around this in a clockwise fashion. So it goes from that improving to leading to weakening to lagging. And what we want to be trying to capture is anything that's moving from the improving into the leading and weakening. So really these three quadrants are where we want to be. We don't want something that's heading down in the improving quadrant. We want it heading up. And you can see here that Canada relative to the US is in that improving and continues to broaden out. So we think that after really a decade of having the Canadian markets underperform, we could actually see the Canadian markets start to outperform. When we look at our sector scorecard, and this is something that we do from a proprietary basis at StoneCastle, what are we seeing? Well, we're seeing a few different things. We're seeing that TSX, large caps, mid caps, small caps have all been strong. The strongest area right now continues to be in the small caps. And then we're starting to see some relative strength changes in the large cap and the mid cap section. And then looking specifically at the sectors themselves, we continue to see strong relative strength in energy financials. And this is, relatively new. It's only been, kind of in the last half of 2020 and the first part of this year that we started to see that. We continue to see healthcare fairly strong. The materials have been strong, but it's really been the base metals. Precious metals were strong for the first half of 2020, and since then they've actually been quite weak. And then tech, which has obviously been the focus here in the last few weeks, has really deteriorated now, and it looks like some of these other sectors are going to take over relative strength and head higher. So what are we looking at when we look at individual stocks? So once we know kind of, are we on offense, are we in defense, are we in neutral? And the next step is obviously looking at it from a bottom-up perspective. And so what we're looking at there is we're looking for companies that are experiencing some sort of catalyst in their business that's going to accelerate their earnings profile. And why we want that accelerated earnings is because when we look at making money in stock price, there's really two ways that we can do it. One is as the earnings and the stock price track each other. So as earnings increases, the stock price will typically increase as well. But the second is from a valuation standpoint. We're typically finding companies fairly early on when these catalysts are just starting to show up. And, as a result, the multiple that investors are paying isn't that high. But as investors recognize that accelerated rate of growth, they pay higher and higher multiples. So we can really make money in two ways. One, from that stock price and their earnings tracking each other. The second is as the multiple itself expands. And then we're obviously looking for, some different criteria for our different portfolios. So as an example, with our income portfolios, I talked about the attributes and characteristics. Well, specifically the, dividend growth and lower than market beta are two attributes or characteristics that we look for. And then obviously valuation, I sort of touched on this already, but, we're looking for companies that have reasonable valuation and have, and that's not just relative to their growth rates, but also to their peers, and also looking at it from a balance sheet perspective as well. So, that's obviously important. So how do we do this at StoneCastle? Really what we do is we look at our companies and rank them based on those criteria of really, where things are at from an acceleration of earnings standpoint, from a valuation. And really every day what we're able to do is we rank our universe really kind of from 1 to 1,000. We know exactly where, all those companies shake out from a fundamental basis. And it allows us to rank them so we know who has the strongest earnings, who has the best valuation. And then as those two start to change positions. So, maybe the valuation starts to go up because the stock price has been going up. It's going to come down in this ranking, and it's going to get to a point where we want to replace it at some point in time. We also look at things from a valuation standpoint. Obviously, we're constantly monitoring that. If it's earnings per share, if it's price to book, you name it, the different metrics, we can watch those, and we're kind of always on top of that. Now, the next thing that we always are looking at is we're looking for relative strength. And so, people think of relative strength in a lot of different ways, but we really think of it as, supply and demand. And so, what we're trying to do is we're trying to keep our portfolio with the strongest relative strength. So on this relative rotation graph, we want to have most of our portfolio in the improving, leading, or weakening quadrant. And you can see here, this is just an example of StoneCastle fund right now. And you can see that, really all of our names go in those three quadrants. And you can see here how, things work. They, continually go through. So, there's times when we'll own stocks that are strong as they move into the weakening quadrant and look like they're going to head to the lagging, based on, what we see both from our fundamental and technical basis. We'll sell them and then wait for them to recirculate around when things come around. Now, whenever you're building a portfolio, I like to talk about this as well. To me, it's very important to have position sizing. Many of you know that I'm on Market Call with BNN on a fairly regular basis. And of course, one of the fun things of being on Market Call is that they always ask for your top picks at the very end. And, there's lots of times when top picks, I'll come back a year later and our top picks are down. And, I'm sure most of the people in TV viewing land think, oh man, Bruce really doesn't know what he's talking about. And in reality, we've made money on that stock because we have sized it for position. We've also managed that position around, kind of what the catalysts have been and how that stock has moved. And so, one of the things that we think is very important is position sizing. So we typically will trim back our positions as they start to run. And, if they pull back, we'll add to them. So this is a good example of a company that, we owned in the past in our portfolio. CRH Medical, probably one that a lot of people are familiar with. It's just recently been announced that they're going to be bought out by Well Health, which is another one of our holdings. But you can see here, when we added to the CRH position, as it started to appreciate, we started to trim back our sizing just because of weight. We eventually started to sell it all out. CRH, dropped way down. It's obviously come back now with it being bought out. But this is the type of portfolio management that we take quite seriously, and we think really adds to what we do, at StoneCastle. In addition to that, that selling process, we take, stop losses and selling quite seriously. And we think that, it's easy to make money to buy, but it's harder to know when to sell. And so typically what we're looking at is we're looking at a number of different tools. In this case, this is just, one simple tool that we use that helps us to determine our stop loss as well. If you look at our rankings, when they drop down in the rankings. Now, obviously I don't get paid to make mistakes, but also don't get paid to promote other people. But I'm going to talk a little bit about a book that, I think is important. But before I do, just going to touch a little bit on StoneCastle performance. You can see here, how our StoneCastle fund, which is our our top ideas fund, has performed over time. You can see, since inception, we're about 14% in the last 10 years, which is above the TSX total return at 5.6. And since inception, we're 13 versus the TSX down here. Now, when I talk about position sizing and having a discipline, we think it's really important to know, in two cases, what to do with your portfolio. One is when you're winning and one is when you're losing. And if you haven't read it, this is a book that I think is awesome. We don't get anything from, suggesting that to read this book, but this, the author really talks about what to do when you're winning and what type of investor are you? Are you a rater or are you a connoisseur? He also talks about probably what's more important is when you're losing, like when you're down, are you a rabbit or are you an assassin or are you a hunter? And he defines all these different types and really goes through, what it is that you should be doing with your portfolio and know at any given time, what you're doing and how that is going to work. So that's, that's really what we do at StoneCastle. And what I thought would be interesting now is just to throw out a couple of ideas for everyone, just to so that you have a sense of, kind of what we're doing with our portfolio right now and where we think there's some opportunities. So in this case, this is a company that we own in our portfolio, Good Natured. They make plant-based products for packaging. And, really what they've been doing is they've been growing organically, and they've also been growing by acquisition. Their revenue growth last year was about 70%. They anticipate that their revenue growth could be, kind of anywhere from 70 to 100% this year again. Really what they do is they go out, they make acquisitions, sort of in the small mid-sized category. And then once they have those customers, kind of in their stable, they're their customers, then they start to cross-sell them different products. So, their history has been in plant-based packaging, which obviously is, quite the trend right now. But they introduced new products. They introduced those existing clients to other products, and they've been able to grow via acquisition and also organically. And they're basically targeting about 50% per each. You can see the stocks had a nice, fairly nice move. They announced some acquisitions last year. And then again, this year, stock just recently closed the financing. It's just sitting actually right at that financing level right now. And we think it presents a real strong opportunity. From a valuation standpoint, the stock, trades at about 6.5 times revenue versus the peers at 14. And, they really aren't focused on generating EBITDA right now, because their real focus has been on revenue and ramping it up. They want to get to that 100 million in revenue, at which time, they obviously become, a more significant player and participant in the market. Next idea is a company called Viamed. This is a company that we've owned on and off for a number of years. And, they're really in the ventilation market, not the ventilators that, kind of everyone was talking about at the beginning of COVID. These are non-invasive ventilators. So one that you would have in your home if you have some type of breathing problems. You can see here the compounded growth rate since 2010 has been 44%. You're really not going to see stronger growth than that. They serve a number of different patients, and they have, access to, to many different markets. They have, really small penetration of the market. So there's a lot of opportunity for them to expand. They have huge inside ownership. From a valuation standpoint, they continue to really do well. The stock, had a nice move up out of COVID, did a bit of consolidating. We actually sold it in this range here, and we've just recently added back to it. And we think that, there's a strong opportunity going forward. And the last one is, I know, many of you know that we manage a cannabis fund, and that we've been fairly early investors going back to, kind of 2003 in the cannabis sector. Or sorry, 2013 in the cannabis sector, 2003. That was, it's generated a lot of return for us, both in our cannabis funds and our regular funds. And this is an idea that we think kind of flies under the radar. These MSOs continue to expand, they continue to raise money, they continue to grow. And Vext is one that right now is really focused in Arizona. They've got both retail and wholesale operations in Arizona. They recently raised some money, so they have a positive cash position, but they're also positive cash flow from operations, which is kind of unique. Stock trades, at about half the multiple of its peers. They got really strong margins, and with all the MSOs that have been hunting around and looking for opportunities, we think that it's one that obviously the stock price will probably come in line to its peers as people discover it. But the second thing is that, if that doesn't happen, somebody getting into Arizona, one of the MSOs will potentially buy it out. So we think there's, a couple of different ways that you could see catalysts there. As I mentioned, we once a month, we run over our monthly indicators with our indicator update. It's about a 30-minute presentation. And, we like to detail everything. If you're interested in joining that, Neil has put the link for the March 11th one, which is on Thursday, in the chat box, so you can register there as well. You can send us an email to info@stonecastlefunds.ca. So if you have questions, this would be a good time to throw those out there. I see one here. What are Bruce's thoughts on his past picks? So these are BNN past picks. Obviously, I've talked about Good Natured. It's one that we continue to like. Zbeck is one that we've actually just recently exited out of. We still love the company. Just looks like the tide was kind of changing from a stock standpoint. So we sold it at a little bit higher price, and we're watching it to look when we return back into it. This is a sector that's going to have tailwinds behind it, for probably the next decade for sure in the renewable natural gas business. And then Indiva, yeah, it's one that we love. We own it in our cannabis fund and in our other funds as well. And obviously Neil's going to be up speaking fairly shortly. And, we think it's a fantastic story. It's, probably, or, I don't want to steal all his thunder, but, we think it's one that could actually be earnings positive, not EBITDA positive, but earnings positive, in 2021. So that's fairly interesting. We should probably wrap it up here, but it looks like there's one more question here. Thoughts on the percentage possibility of cannabis legalization in the US, and if so, when? Well, my answer was going to be, I think there's a 100% chance that it's legalized, but I just don't know when. I think there's probably a chance that some of that happens this year. Legalization, I'm not too sure if it's full legalization or just decriminalization, or if we saw, say the SAFE Act as the catalyst. So thank you. Thanks very much for joining us. As you know, if you want, you can register for our webinar in the chat box. If you have more questions about StoneCastle Fund or any of our other portfolios, feel free to reach out to us. info@stonecastlefunds.ca, or you can reach out to myself or Jordan. And thanks again, Neil, for having us and hosting us. And pay attention, because the next three companies are all companies that have huge catalysts in front of them.